Time now for Futures in Focus. Oil is extending its slide today. We want to examine why. Joining us from the CME is Ted Seifried, Vice President with Zaner AG Hedge. So there was talk today about demand destruction, Ted. How far do we see the price decline if the fears are out there for demand destruction?
Yeah, it's a great question, Bonnie. You know, the talk today is that the U.S. might be preparing to impose that last $257 billion in tariffs on Chinese goods if the meeting down in Buenos Aires for the G20 meeting doesn't go well. So that's kind of spooking the market a little bit. We also have expectations for another weekly build in crude stocks, although this stocks build might not be as large as previous weeks. We're looking for roughly a 3.7 million barrel build, but that's only about 30% of what we've seen in weeks prior. That's kind of due to low refinery activity. We are sort of getting backed up now at this point. We also have a dramatic increase of imports coming in through U.S. ports, and Canadian rail exports hit all-time highs. So that is all kind of putting some pressure on crude oil here today. But the question in my mind is, you know, will Russia impose an export duty to ease the surging domestic energy prices that they're looking for through the winter? It's kind of raising the question is, does Russia have the capacity to make up for the Iranian, or to help make up for the Iranian sanctions? So let's see what happens there. Now, a lot of what we're seeing in crude today is technically driven in nature. We had a very obvious target below us in the form of that 200-day moving average, which also happens to be our low here today so far. That's at 65.30. Again, it was a very obvious target. Now, this could also be a likely area for crude to attempt to see a bit of a bounce. We would have upside targets of $68 at first, and then also $70.50. However, if we can't hold this 200-day moving average, 63.35 to 62 even is where we're looking.